There are three overriding factors Australia's grain growers are now contemplating in relation to the current winter cropping season. First is the weather, and unusually, this is probably the least of all concerns. As subsoil moisture levels across most of eastern Australia are near perfect, there are dryness concerns in the west, and that's an area to watch closely over coming weeks. Second is the price of wheat. It's really struggling at present. And the third issue is the sheer volume of wheat around both here and throughout the world. Earlier, I spoke with Ron Story from Australian Crop Forecasters. He agrees in volume terms this year's winter grain crop could be a cracker.
Yeah, although it's been a very dry April, Kerry, but 26 million tonnes is the range that most people are talking for wheat, and that's a big crop again, lower than last year. But the subsoil's there, so we've just got to hope that it does rain over May, June to let the farmers get the crop in the ground.
Yes, Ron, you're absolutely right. Of course, weather and actually getting the crop in the bin are always major concerns. But another major concern, of course, is the price. What price can growers expect come harvest time?
Yeah, the news is not that good there, Kerry. The world is awash with wheat at the moment. Here in Australia, we've got a very, very large carryover. And the price incentives of the last few years for farmers to grow more wheat have been kicking in. So there's no real problem with supply of wheat for 2012. But I guess the sobering thing is, from an Australian point of view, we're talking about a crop that won't be harvested until November, December of 2012, and it's not even yet in the ground. So a long way to go, and I think the biggest thing to note about the wheat market these days is that it always seems to be just a year-to-year proposition. We don't seem to be in a long-term surplus situation or a long-term deficit. The market has become very volatile from year to year. Demand remains very strong. So a lot can happen between now and when the farmers get to harvest their crop.
Ron, you consult with farmers every day. What's the trend at present? Are they locking in a price for December, or are many willing to take a punt on the spot price at the time?
Well, I think it depends which crop we're talking about. If we were talking about oilseeds, and in Australia that basically means canola, we're seeing, in a way, a raging soybean and therefore oilseeds market at the moment, and very, very good prices. So we would be saying to farmers, if they feel confident of their production risk, that they're going to have a crop of canola, then these are very good prices, and you should look very, very hard at locking in some of the profits at these levels. As far as wheat is concerned, we wouldn't see any incentive to do that. The crop is not even planted here yet. The forward prices for December of 2012 look like, at the moment, that they'll be lower than what they were last year. So that's not good news. So we couldn't see any real incentive for taking that risk today to start pricing a crop that we haven't even yet planted.
Now, that lift in canola plantings are massive, both here and in Canada. Is that based on demand, or is there just simply an understanding that perhaps farmers can get a better return from canola outside wheat?
Well, it's really driven by what seems to be an almost insatiable demand for soybeans around the world, but in particular in China. The demand for soybeans in China is quite extraordinary. They're importing around 60 million tonnes. That's over 1 million tonnes a week of soybeans. And that is driving soybean prices, it's driving oilseed prices, and it certainly has led to the big increases in canola acreage, both in Canada and here in Australia.
Back to wheat for a moment, Ron. We've seen prices weakening for some time now. Is there more downside for wheat?
We've been in the business long enough to know that you can never say it's bottomed out or topped out, Kerry, but we would say it's in the lower range of where it needs to be longer term if we're going to have the world producing enough wheat. So at these levels, we think we're at the lower end. I'm not saying it can't go down further. You know, we could have a higher dollar, which of course on its own would take our prices lower. Wheat prices on their own in US dollar terms are actually not too bad, but the Aussie dollar, when it's above parity, makes it tough to make good returns here. So we think they're at the bottom end. There's probably upside, but it's tough to see it happening in the next 6 months unless we see a weather problem somewhere around the world during that period.
Wheat's a little odd, isn't it? I mean, there's a hell of a lot of wheat around the world, but demand is fairly consistent to cope with that volume.
It is, Kerry, the last 5 or 6 years, demand's been very steady, very strong, and we've just got an ever-increasing levels of disposable income in Asia, and that's changing their diet. They're eating more meat protein than they are grain protein, and that means more grain consumption. So that's where the demand is coming from, and we don't see that being turned off.
Ron Story, always good to have your expertise on Landline. Thank you again.
Thanks, Kerry. Always a pleasure.
So prices are bearish at present and likely to remain so. But as Ron Story points out, a major weather event in one of the big exporting wheat countries would change that price outlook instantly. Australian futures have held up okay this past week, although there's some pressure around from the bounce in our dollar and weakening American prices. New crop prices are also holding up pretty well. Pro Farmer is reporting that carryover wheat stocks at the end of the year will be 9 to 10 million tonnes. That's absolutely massive. And despite the fact much of this will be lower grade, it's bound to impact on local prices. So here are the grain court numbers. That canola price is against the overseas trend for the moment at least. Chicago had an up and down week. Very hot weather in America and some Black Sea countries had little impact. Traders reported a sale of 300,000 tonnes of wheat to Iraq. Australia picked up some of that at a CNF price of about 340 US a tonne. That soybean price and the soybean story is amazing. More on that next week. Corn supplies are tightening. World production this year, about 900 million tonnes. World consumption, about 893 million tonnes. To livestock now, where it's been an intriguing week. After the crash of last week, many producers withheld stock, and combined with the midweek holiday, numbers on offer were way down. Queensland was down 53%, New South Wales was off 46%, and Victoria declined 66%. Quality is also suffering as the colder weather descends, reaching the Sunshine State later in the week. Trade cattle bounced, but other categories continue to slide. Now, this action saw the Eastern States Young Cattle Indicator settle down 5 cents to $3.67 a kg. That BSE scare from America, where one very old dairy cow in California tested positive, is not expected to have any major long-term impact. But it could not have come at a worse time for American producers, who are just about to ink an agreement with Japan to lift the age of the beef cattle used for exports to that country. Beef Central has found interesting statistics about BSE. In 1992, worldwide testing for BSE resulted in 37,000 positives. Last year, that number was down to just 29. In news from the north, the live trade is chugging along, with some exporters finding it actually tough to get shipping space. Heifers $1.60 and steers at $1.75 a kilo, and there are plenty of cattle around. Sheep and lamb numbers also went backwards last week. In Victoria, offerings were off a massive 74%. So prices reacted accordingly, picking up most of the losses from the previous week. That mutton price is about $1.70 a kilo, down on this week last year. Let's head back to New York for the soft commodities, and the significant call this past week was with sugar. The Indian monsoon looks set to deliver normal rainfall, and this will mean India, the world's largest consumer, will become an exporter of sugar in 2013. So sugar slumped to its lowest since May of 2011, while cotton was steady. That price is about the equivalent of $440 a bale. Finally to wool, where latest figures indicate Australia might have turned the corner with sheep numbers. After years on the slide, our flock this year should lift to 74.3 million. That's up about 5% on last year. Auction prices last week were steady, which was obviously a relief for many producers after 4 weeks of decline. As usual, China led the way in sales, where the Eastern Market Indicator closed at 1,165 cents a kilo. This is about 57 cents below the season average. And that's the Landline check on prices.